The CEO slams the table. In 2008, $4.5 trillion was injected into the economy. Yet, the same banks created $1.2 trillion in fake money overnight. This hidden mechanism allowed them to profit from the crisis while the public bled. But how did they legally generate billions without any real assets to back it up? The system allowed it. Banks create money by lending, not printing, and it's legal because the law says so. The Bank of England's 2014 report confirmed 97% of modern money is created by banks as loans, not central banks. You've seen the headlines: grocery prices soaring, retirement savings dwindling, homes vanishing into the void of a mortgage crisis. But what if the real story isn't about greed or fraud? What if the system itself is designed to let banks conjure money from nothing legally every single day? Take the 2008 crash. The Federal Reserve's quantitative easing pumped $4.5 trillion into the economy, yet millions still lost their homes. How? Because banks didn't need physical cash to lend. They needed only a signature. A single mother working 2 jobs, her rent check bouncing, while a bank's balance sheet swells with loans created from nothing. This isn't magic. It's the fractional reserve system, a rulebook written in 1913 that lets banks lend 10 times more than they hold in reserves. By 2020, the Fed axed reserve requirements entirely, giving banks the green light to create money at will. The illusion of value is the game. You think your paycheck funds your rent. No, your rent funds the bank's next loan. And the law? It's on the bank's side. The next time you see a mortgage rate drop, remember, that's not a favor. It's a power play. The fractional reserve system is the bedrock of this illusion. Before 2020, banks could lend up to 10 times their reserves. $1,000 in deposits could become $10,000 in loans. But in 2020, the Federal Reserve axed reserve requirements entirely. Now banks can lend 100% of deposits. A single mother's $2,000 paycheck, it becomes a $2,000 loan, then a $20,000 loan, then a $200,000 loan, all while the original $2,000 remains in the bank's vault. No physical cash needed, just a signature. The money multiplier formula, a relic. Post-2008, the Federal Reserve's balance sheet swelled to $4.5 trillion through quantitative easing, but banks didn't need that. They needed only the legal loophole of zero reserve requirements. The Bank of England's 2014 report made it explicit: commercial banks create money out of nothing. That's not a metaphor, it's a legal fact. The Fed's QE wasn't just a bailout, it was a power play. By flooding the economy with electronic money, it inflated asset prices, favoring banks and the wealthy. A 2023 Federal Reserve study shows the top 10% of Americans own 77% of wealth, while the bottom 50% hold just 2%. Creating stimulus didn't fix inequality, it deepened it. Banks, now free to lend unlimited amounts, weaponized this system. In 2007, subprime mortgages were created from thin air, packaged into securities, and sold to investors. When the loans defaulted, the banks had already profited from the interest. The 2008 crash wasn't a failure of regulation, it was a failure of accountability. The Fed's QE post-2008 repeated the same pattern. Money created from nothing, directed to markets, leaving ordinary Americans to pay the price in inflation and stagnant wages. The legal framework? The Federal Reserve Act of 1913 granted the Fed authority to manage monetary policy, but it also let banks exploit the system. The Uniform Commercial Code enabled this by allowing credit extension without full reserves, as long as solvency standards were met, a loophole that remains unchallenged. The illusion of value. It's not just economic, it's psychological. You think your paycheck funds your rent? No, your rent funds the next loan. And the law. It's on the bank's side. The Federal Reserve Act of 1913 didn't just create a central bank, it codified a power play. By granting the Fed authority to regulate banks and manage monetary policy, it handed over the keys to the money supply to a system that would later be weaponized. The 1913 law allowed the Fed to create money through open market operations, but it also let commercial banks exploit a loophole: fractional reserve banking. The Bank of England's 17th century model, where central banks issued currency backed by reserves, was replicated in the US, but with a twist. By the 1980s, deregulation, like the Depository Institutions Deregulation and Monetary Control Act, slashed reserve requirements, letting banks lend more with less. Then came the Gramm-Leach-Bliley Act of 1999, which dismantled the Glass-Steagall Act's firewalls, allowing commercial banks to merge with investment firms, a move that blurred the line between lending and speculation. The real shift, though, came in 2020, when the Fed axed reserve requirements entirely. No more needing to hold 10% of deposits in reserves. Now banks could lend 100% of deposits, effectively creating money from nothing. The legal framework? Fiat currency, born from the 1971 abandonment of the gold standard. No longer tethered to physical gold, money became a construct of law and paper. The Uniform Commercial Code, a U.S. legal framework, enabled this by allowing banks to extend credit without full reserves, as long as they met solvency standards, a loophole that remains unchallenged. The Fed's QE programs, injecting $4.5 trillion post-2008, weren't just economic tools. They were power plays, inflating asset prices to favor the wealthy, while ordinary Americans faced stagnant wages. The law didn't just permit this, it made it inevitable. By 2023, the Fed's balance sheet still bore the scars of this system, a silent testament to how money creation became a legal, if not ethical, weapon. The rules, written by those who profit from the system, the victims, those who pay the price in debt and inequality. The 2023 Federal Reserve data reveals a stark truth. The top 10% of Americans own 77% of the nation's wealth, while the bottom 50% hold just 2%. This isn't a coincidence. It's the direct result of a system where banks create money from nothing, then charge interest on it. The same banks that lent $4.5 trillion into the economy post-2008 through quantitative easing didn't just flood markets with liquidity, they weaponized it. Lower interest rates made mortgages cheaper for a time, but home prices soared as banks funneled money into real estate, inflating assets for the wealthy, while middle-class families were left scrambling. In 2007, subprime mortgages were created from thin air, packaged into securities, and sold to investors who didn't realize the loans were backed by nothing but hope. When defaults hit, the banks had already collected interest, leaving homeowners with underwater mortgages and investors with worthless paper. The 2008 crisis wasn't a failure of regulation, it was a failure of accountability. The Federal Reserve's QE programs post-2008 repeated the same pattern. Money created from nothing, directed to markets, leaving ordinary Americans to pay the price in inflation and stagnant wages. The legal framework. The Uniform Commercial Code allowed banks to extend credit without full reserves, as long as they met solvency standards, a loophole that remains unchallenged. By 2020, the Fed's elimination of reserve requirements made this system even more ruthless. Banks could now lend 100% of deposits, turning a single mother's $2,000 paycheck into a $200,000 loan, then a $2 million loan, all while the original $2,000 remained in the bank's vault. The illusion of value. It's not just economic, it's psychological. You think your paycheck funds your rent? No, your rent funds the next loan. And the law. It's on the bank's side. The system was designed to let the powerful profit, while the rest of us pay the cost in debt, inequality, and a rigged game. we're never told we're playing. The unseen battle for control is fought in boardrooms, legal loopholes, and the quiet corridors of central banks. It's not just about money, it's about who writes the rules and who enforces them. The Federal Reserve Act of 1913 gave the Fed the power to create money, but it also handed banks the keys to a system where lending is a form of leverage and regulation is a tool for maintaining the status quo. The Gramm-Leach-Bliley Act of 1999 dismantled firewalls between commercial and investment banks, allowing the same institutions that issue loans to also trade the risks of those loans on global markets. This isn't a coincidence. It's a calculated power play. By 2020, the Fed's elimination of reserve requirements turned banks into money-generating machines, unshackled from the need to hold even a fraction of deposits in reserves. The Uniform Commercial Code, which permits credit extension without full reserves as long as solvency standards are met, became the legal backbone of a system where banks profit from the very debt they create. For the average worker, the takeaway is clear. Track your bank's lending practices, advocate for reserve requirements, and invest in assets that hedge against inflation. Real estate, gold, or even a diversified portfolio of stocks can act as a buffer against the systemic risks of a money creation system that favors the wealthy. But the real power lies in awareness. The 2023 Federal Reserve data, showing the top 10% own 77% of wealth, isn't just a statistic. It's a blueprint for how the system is rigged. The boardroom is a battlefield, and the rules are written by those who create the money. If you don't know how it's made, you'll always be the one paying the price. Subscribe for more breakdowns of corporate power psychology. Tell us in the comments, what's the most ruthless power play you've witnessed at work?